Hello guys, my name is Manan Patel and welcome to my channel, Dream Investing 101. The purpose of this channel is to educate investors on the fundamentals of the stock market. Because of the pandemic, many investors have developed an interest in investing. Yet it is very easy to lose money in the market if you do not have a clear understanding of what you're investing in, why you're investing in it, and the purpose of your investments. My goal is to teach whatever I can to help investors make the right decision with the right amounts of information. This channel will focus on explaining simple yet important fundamentals of the stock market in an easy manner. The purpose of this channel is to grow so that eventually we talk more in depth about a particular stock or the whole market in general once we have covered all of the basic topics. So let's get started. In order to fully understand the stock market, let's get started with the basics first. So let's first understand what a company is. A company is a business organization that makes, buys, or sells goods and also provides services as well, like Netflix, in an exchange for any sort of monetary value. This can be money, cryptocurrencies, or commodities as well. Now that the economy is constantly growing, companies are now more open to accepting things like Bitcoin, Dogecoin, and Ethereum as a sort of payment as well. Companies can also be private or public as well. One step ahead of a company is called a corporation, and corporations are owned by its shareholders. And an example of a big corporation is Microsoft. Individual investors like us can also be shareholders of Microsoft as well. All we need to do is just buy one share of the company. So now that we know what a corporation and a company is, let's understand the biggest difference between them. One of the biggest difference is that a corporation is owned by more than one person. They're typically owned by its shareholders, which are more than one person, while a company is typically just owned by one person. Corporations can be either public or private. So let's get started with defining what a privately owned company is. Like the name says, a privately owned company does not sell itself to the public. Their ownership is transferred privately over the counter, which means that they do not have to report which means that the news does not report their transfer in ownerships. The transfer in ownerships of the stake of the company is less under the radar than a publicly owned company has. The company is just run by its founders, management, or other private investors. Shareholders like us do not have a say in where the company goes, what the company should do, or what the company should invest in. And an example of a big privately owned company is SpaceX. So let's first understand the advantages and disadvantages of a privately owned company. One of the biggest advantages of a privately owned company is that there is less government control on the business. The government is not constantly keeping tabs on them like a publicly owned company has. The SEC, which is the Securities Exchange Commission, is constantly hovering over public companies in order to make sure they're doing the right thing. Now, I'm not saying that private companies can do whatever they want. Yes, they still have to follow rules and regulations, but they're more or less likely to be scrutinized than a publicly owned company is. Another advantage is that they can keep their finances private. Now, what does this mean? This means that private companies do not have to report their earnings every 3 months like a publicly owned company does. Now, in an earnings call, a company would have to give how much they earn, what their future projections are, where they stand, what their cash flow is, how much do they lose, what are the costs of goods sold, etc., etc. They have to report all of that to their shareholders. But a privately company does not have to do that. They don't have to go every 3 months reporting to their shareholders their finances. They can do that when their shareholders ask, or they can do that when They can do that when if they want to pitch it to their future investors, but they do not have to constantly keep revealing their finances to the public. And another advantage is that the company is more focused on long term. They are not really settled in on the short term goals like a public company is. Now, don't get me wrong, public companies are more long term oriented as well, but individual investors like us typically, like I mentioned, want more short term returns than long terms, which is why publicly owned companies are constantly under the pressure to perform more short term goals than they are more long term. While privately companies are not expected to be profitable the very first quarter they start, they're typically projected to be profitable more in the long term after the business slowly but surely matures. A disadvantage of a privately owned company is that they have access to less capital. Now, what does this mean? Less capital is basically less investments. Privately owned companies do not have that marketplace for them to gain more money in order to invest in their future ventures, like a publicly traded company does. Another disadvantage is the restrictions on transfer of shares. In order to transfer shares in a publicly owned company, you can either directly buy or sell shares, and the process is fairly simple. But a transfer of ownership in a privately owned company is not really simple. They have to follow many different legal requirements and procedures in order to transfer their ownership from one person to another. Another disadvantage is that profits may occur over a longer time period. Now, yes, I did say that the long-term focus of a privately held company is one of their advantages, but keep in mind that if the company is constantly losing money over consecutive quarters, then that may not be a good sign as well, because the company is burning out cash flow more quickly, or it can also mean that a company is failing to achieve its short-term goals, which can lead to bigger problems if this continuously follows up. So now that we understand what a privately owned companies are, let's understand what public companies are. The basic definition of a publicly owned company is that a public company or a publicly traded company is a company whose ownership is organized or traded through shares of a stock, which are intended to be freely, of course. These companies can decide to sell all or a portion of itself to the public. They do not need to give themselves up to the public completely. And they do this through an IPO, which is called an initial public offering. A very big example of a publicly owned company is called Nvidia, which is a semiconductor company, which is the leading maker of GPUs, general processing units, and have recently expanded into the autonomous vehicle markets by developing chips for them as well. Now, you don't need to worry about these two numbers that I put up here, but if you want to know what they mean, a market cap just states the current market value of the company. And $551 billion is the current market value of Nvidia, which shows that it is a large cap company and they are worth a ton of amount. And what is an institutional ownership? Well, institutional ownership is basically ownership by hedge funds and other large entities. And 65.76% is a big number because it shows that more than half the people who trade or own Nvidia are big hedge funds that like to keep shares of the stock. So let's understand what the benefits and disadvantages of a publicly owned company is. Well, one of the biggest advantages of a publicly owned company is that they can raise money for their future ventures more easily and more quickly. A big example of this is Amazon. Amazon's stock has grown more than 3% in the past 5 to 6 years, which is a big reason why they have been able to expand into different markets, like the grocery market, pharmaceutical markets, delivery markets, and other markets as well. They have been able to buy companies like Whole Foods, Ring, Zappos, Audible, and such on. And the biggest reason for that is basically the constant increase in their stock over the long term, which is giving them the right to grow their business at a more rapid and smooth pace. Another advantage is liquidity is enhanced for these investors. what is liquidity? Liquidity is basically converting current assets into cash more quickly. So for instance, if I own one share of Amazon, which can also be termed as an asset, I can share that one share at a more rapid pace in the stock market if I wanted to share that right now. Another advantage is that these companies can market themselves more globally, or they have a broader advantage of marketing themselves. Typically, we do not really hear of private companies in the news unless something very big happens. But publicly traded companies are more in the news than a privately owned company is. A very good example of this is last year during the pandemic. I wasn't really familiar with what Peloton was. Peloton has grown a ton in the last year. And one of the biggest reasons why is because of COVID. But not just because of that, but they have also received, you can say, a sort of free marketing because of the stock market. Their stock has constantly been increasing, which is allowing them to market themselves at a more global reach than if they were private, let's say. But a disadvantage of a publicly owned company is that the cost of going public is very expensive and it can take a ton of time. And what do I mean by this is that lawyers, investment bankers, and accountants, they are all required. And that these they do not only have to pay them, but if something goes wrong in this whole process, then it can really disrupt the pace of the business and their momentum and how their ability to make money over the future. Another disadvantage is the increased government control, like I mentioned. Publicly owned companies are constantly being monitored by the SEC, Securities Exchange Commission, and that they need to constantly be in tabs with them in order to constantly be growing their business. And if they do something wrong, then they're under big scrutiny, and the SEC may be able to harm the business potentially, which can really disappoint their current shareholders. Another disadvantage is that they're under constant pressure of achieving the expectations of the investors. Now, what does this mean? Companies have to report their earnings every 3 quarters. So if something goes wrong during that earnings call, then they typically tend to tank the stock by a lot. The stock goes down by more than at least 2 to 3% most of the time. And the big reason why is because they are not able to match the current expectations of the investors. And the management needs to keep in mind that they have to constantly be under tabs with what their investor wants, and that they have to make sure that they follow up with what the investors expect. And if they don't, then that could really potentially cost the company a huge amount of money. So now that we understand what a publicly and a privately owned companies are, let's understand why we need to invest in either of them. Let's start with publicly owned companies. Well, this is not always true, but one of the big reasons why you would want to invest in a publicly owned company is because they are more safer and established, and they have to report everything to the SEC. You can find an information of any publicly traded company on the website called secedgar.com. You can search up their annual reports, their income statements, balance sheets, cash flows, etc., you name it. You can find all their information of that company. So you can say typically more safer than a privately owned company, where a privately owned company do not really tend to make profit the very moment they start doing business. Another interesting thing about a publicly owned company is that they tend to pay dividends. Now, keep in mind, not all publicly owned companies pay dividends, but a lot of them do. And in a future video, I will explain how you can calculate the amount of money you make from dividends. And these companies tend to pay dividend. It could be monthly, quarterly, or even yearly as well. And the last major reason why you should invest in a publicly traded company is because it's easier for you to cash out of your position, or in other words, high liquidity. And that is really important because let's say if you feel like the company is not going to do well over the next 2 or 3 months, or they're going to lose money, it's It doesn't take time. You can easily just say, okay, I want to cash out my position. I'm happy with the money I made, or I don't want to lose more than what I have. And you can just take that money out of those shares and put them back in. But in a privately traded company, you cannot really do that. It's going to take you some time. It can take you weeks, months, years, maybe. It's a tedious process. So now that we understand what the benefits of investing in a publicly traded company is, let's understand the benefits of investing in a privately owned company. It's not as volatile. So you're not going to lose your investments overnight. A publicly traded company is more in the news than a privately owned company, typically. So let's say if the company's earnings are not that great, then typically the investors tend to tank the stocks by a huge margin, and you can lose a big chunk of your investments. But in a privately owned company, it's more through a time process, so you do not have to worry about losing your investments overnight. Another reason why you should invest in a private company is that you can get more stake. So when you invest, let's say when you buy one share of Microsoft, if you divide that one share by the total market cap, that is how much portion of the company you own. And if you take Microsoft, for instance, their current market cap is somewhere around $1 trillion. So if you divide 1 by 1 trillion, you don't even own a 0.1% of the company. You own much less than 0.1% of the company, which just goes to show that how much less of a factor you are in the business. Well, in a private investment, you're more likely to get more stake, more than 1% stake in the company, which is a good thing because you can be more involved in the business. You can help with the management. You have more say in the business, and it allows you to help grow the business into a more better place. While in a publicly traded company, less than 0.1% ownership means really nothing, and you're not going to be earning as much of a profit, let's say if the business were to succeed or grow overnight, as you would in a private investment, because you have more equity stake in the company. And the last one is really interesting because you can structure your investments in a privately owned company. A lot of us have seen the show Shark Tank, where investors tend to structure their deals by giving royalties, debt, or certain commissions, or something like that. They can structure their deals. You can also do that in a privately owned company, where you can make your pitch that, okay, I want a certain royalty, or I want this much money until or this much equity stake until I make all my money back. You have the ability for you to structure your deals in a privately owned company, and it's all legally done, so you don't have to worry about it. But in a publicly owned company, you don't have the advantage. You can't just say, okay, I want this much stake and I'll invest this much. It's just basically hands-on. Like, this is what you get, and this is how much it's per share. And if you want it, great. If you don't, you don't need to buy it. Like, it's kind of like that situation. You can't really structure your deal, so you're stuck with what you have. And sometimes that could lead to giving low return on your investments, which is not that great. So thank you guys for watching this video. Hope you all liked it. If you guys have any questions, feel free to comment and I will get back as soon as possible. Please make sure to like and subscribe this video, and don't forget to share it if you like it. I will come back with another video very soon. Have a nice day, everyone. Thank you.